Hello, my name is Alison Shimada, Senior Portfolio Manager for the Total Emerging Markets Equity Team here at Allspring Global Investments. I'd like to take this opportunity to share with you my observations from Q2, where we're seeing opportunities and challenges across sectors and regions, and why we remain positive on emerging markets going forward. Emerging markets equities rebounded 3.5% in June, boosting Q2 performance back to positive territory. A weak economic recovery in China this year and geopolitical risks are well known and almost already priced in. The Chinese government has erred on the conservative side and needs to introduce more fiscal and monetary support in the coming months to preserve GDP growth in the 4 to 5% range. Risk reward for Chinese equities is starting to look more attractive on low valuation, increased efforts by China and the US to engage, and potential fiscal stimulus. Alongside China is India, which is China 20 years ago, with a young, increasingly well-educated population, a stable central bank, and a popular government that is becoming more operationally efficient. There are multi-year possibilities of returns in India in banking, real estate, and infrastructure in particular. While the developed market recession is possible, we expect the semiconductor cycle to bottom this quarter and look to the rise of machine learning, artificial intelligence, and ChatGPT to drive new product cycles. This bodes well for technology-heavy markets, including Taiwan and Korea. Latin America looks attractive given low valuations, stable ROEs, access to natural resources that are important in the EV supply chain, and government reform in countries like Brazil. Mexico should continue to benefit from tourism as well as manufacturing reshoring. Brazil could also start to be considered more favorably as an industrial base due to its abundance of land, labor, and improving legal transparency. At the moment, the Middle East is not as compelling due to its higher valuations and the correlation with oil prices that are range-bound currently. Also, the government in South Africa is not as proactive in addressing corruption and stabilizing its power infrastructure, so we remain cautious there. We see an earlier end to tightening cycles in emerging markets compared to developed markets, and EM valuations overall are attractive at 12 times forward earnings and 1.5 times price to book, trading at a large discount to developed markets. Emerging markets' corporate balance sheet strength and returns are near pre-pandemic highs. We remain positive on emerging markets with the US dollar having peaked, and as the relative growth premium of emerging markets versus developed markets expands once again. Thank you.